Brace yourself, because it's starting to look a lot like the 1970s again. You know, the decade of inflation, where prices on pretty much everything went through the roof. Where median home prices increased from $27,600 in 1972 to $69,300 by 1982, reflecting more than a doubling, almost a tripling in prices. Crude oil prices rose from $3.29 per barrel in 1973 to $32.97 by 1982, which represented a 10x increase in prices. And purchasing power, well, thanks to a little thing called inflation, it went down substantially, with $1,000 in 1972 having the exact same buying power as $480 in 1982, a 52% loss over a decade. Now, contrast that to the last 4 years, where we've seen purchasing power in just 4 years decrease by 18%. We've seen home prices rise from $329,000 in Q2 of 2020 to $420,000 in Q4 of 2024, reflecting a 28% increase. And food prices, well, they've gone up as well, with the price of a loaf of bread increasing from $1.50 in June of 2020 to $2.10 in December of 2024. A 40% rise. And what's really scary is that when you look at the trends in inflation and the fact that in the 1970s, inflation did get back down to 3% right before it spiked on 2 separate occasions, ultimately with it increasing up to almost 20%, well, things are starting to get a little bit scary, which is why you should probably be taking steps right now to brace yourself for the rest of the decade. And I'm going to tell you exactly how in this video. But before we get into it, my name is Nolan Matthias, and if you want the truth, the real truth about personal finance, this is the place for you. And if you believe that there's opportunity in crisis, then definitely go ahead, hit that subscribe button so you always get the latest videos as they come out. Okay, so let's get into it. Let's discuss the similarities between the 1970s and current day, talk about the real risks to the economy and to your personal pocketbook, and talk about some of the things that are maybe different. Because even though 1972 is looking a lot like the beginning of 2025, there are some distinct differences. And there's also some significant dangers on the horizon. So let's start by talking about purchasing power between 1972 and 1982. Yes, there was in fact a 56% loss in the purchasing power of the US dollar. But that's normal. Typically, at any given time, as the money supply is increasing, and it's always increasing, we're going to see a loss in the purchasing power. But 56% in a decade is a little bit over the top. But what's scary is that when you look at the last 4 years post-pandemic, the US dollar has lost 18.6% in just 4 years. And the question is, will we continue to lose that purchasing power as the decade moves on? And keep in mind that purchasing power is important, especially when wages aren't increasing. Because if the dollar you have today buys less tomorrow, but your wages aren't going up, well, that has a pretty significant impact on your day-to-day lifestyle. And even more importantly, if you aren't doing something to make sure that your money, your savings, your investments are also growing at least the rate of inflation so that your investments are growing in line or at a greater rate than what inflation is growing at, well, then you're actually leaving a lot of money on the table. And what causes a loss in purchasing power is quite simply inflation, prices of goods going up. And if you look at the last 4 years, well, the 2020s have been the era of pandemic-powered inflation. Now, the bad news is inflation got as high as 9%. The good news is that inflation has come back down into the 3% range. However, we haven't seen inflation this bad since the early 1980s. In fact, the last time that inflation got as high as it did in 2022 and 2023 was in the early 1980s, almost 40 years ago. Now, the good news is the Federal Reserve has managed to get inflation back down to 3%. But unfortunately, the scary thing is, in the early 1970s, the exact same thing happened. Inflation increased up to about 6%, emergency measures were put into place, and the inflation rate was brought down to 3%. And for the most part, everybody thought that the worst of it was over. But the worst of it wasn't over. In fact, it got significantly worse over the next decade. And that is what many people are fearing today, is that the pandemic-powered inflation of 2020 to 2024 is just the start of what is about to come. A 1970s-style era of massive inflation. An era that looks a little something like this, with history repeating itself, or at the very least rhyming. With inflation spiking, coming back down to 3%, and then increasing substantially once again over the next decade. But the question that I'll answer in just a minute is what exactly caused those two big spikes after inflation got under control in 1972, and is that a concern going forward? But first, I think it's important to unpack 2024, which from an economic standpoint was a year where pretty much everything went up in value. We saw gold increase in value by 30%. The S&P 500 increased by 28%, and Bitcoin, that thing that most people really don't understand, well, its value increased by 122%, meaning that if you had bought $10,000 worth of Bitcoin at the beginning of January 2024, it would be worth an astonishing $22,000 at the end of 2024. But obviously, Bitcoin didn't exist in the 1970s. However, gold did. And many people are now looking to the performance of gold leading up to that second inflationary spike in the 1970s and suggesting that the performance of gold in 2024 is an indicator that inflation could be about to burst once again. Because similar to this period between 1977 and 1980, we're starting to see similar trends in the price of gold today, with the value of gold consistently setting new records, which is exactly what happened in the late 1970s. However, even though the trends in gold and inflation seem to correlate to the 1970s, there are some things that are significantly different. And in order to understand that, we need to take a look at inflation, and specifically the impact of housing, food, and energy on the inflation rate. Because when you look at the consumer price index, which is the yellow line, you can see that yes, it has gone up substantially since 2020. However, there are three things that continue to pull inflation even higher. They are housing, food, and energy. Now, if you take a look at the red line is the CPI minus energy, food, and shelter. And as you can see, without energy, food, and shelter, the CPI is significantly lower than what it is with those three things included. But when you break out food, which is the purple line, and you break out housing, which is the green line, you can see that those two things have inflated significantly more than the rest of the components of the CPI. And the question is, if those two things are adding the most cost to the CPI, how could they affect prices going forward? And could we see a significant jump in the CPI like we did in the 1970s? Well, let's take a look at what's going on with housing prices. Because housing prices have stabilized. As you can see, after about 2022, the housing prices have come down slightly and have stopped their crazy increases. In fact, as of right now, housing prices are pretty much flat. But there's one thing to note here, and that is that housing prices are a lagging indicator, which means there is another indicator, a leading indicator, that can give us some insight on what to expect with housing prices going forward. And that leading indicator is housing sales. Now, as you can see from this graph, housing sales have come down substantially. That has led to the stabilization in housing prices. However, it's important to note that there's typically a correlation between home sales and housing prices. When home sales are on the rise, housing prices tend to rise as well. And when home sales fall substantially, well, guess what? So do housing prices. And what we're seeing right now is a significant fall in the lead indicator, which is housing sales, which could ultimately lead to a reduction in home prices. Now, even though home prices aren't directly a component of the CPI basket, what this means is that the shelter cost component of the CPI basket could find itself coming down, which could see even lower inflation in the future. So as far as housing prices go, this doesn't seem to be the factor that will push inflation significantly higher once again like it did in the 1970s. In fact, with the significant headwind that housing prices are facing, we should start to see inflation stabilize. So then what other factors should we be looking at to see if we're at serious risk of repeating the 1970s all over again? Well, we could look at wage inflation. And as you can see from this chart, the blue line being the average wage inflation in the United States, wage inflation in the US is significantly higher than it has been at any time in the last, well, almost 20 years. But the question is, should we expect wage inflation to continue to go up? Well, wage inflation is, again, a lag indicator, and there's a lead indicator that tells us whether or not we should be expecting that wage inflation to increase, and it is non-farm job openings. Now, what happens with wage inflation is when there is lots of job openings, employers compete to hire employees, which means employees can demand a higher wage. But when the amount of job openings comes down, like they have been over the last 2 years, The inverse happens and employees have to compete for those jobs and aren't able to demand as high of wages. So at the present time, it does not appear as though wage inflation is going to be a contributing factor to a significant increase in inflation similar to the 1970s. So then the real question is this: what caused those two major spikes in inflation in the 1970s? And the answer, believe it or not, is fairly simple. In the 1970s, there was two major oil shocks. The Arab oil embargo, which led to oil prices increasing by 42%, and then a second crisis during the Iraq-Iran war that saw oil prices increase another 102%. And it was these two oil shocks which increased the cost of energy. It increased the price of fuel. It increased the cost of pretty much everything in the economy. And while those two oil shocks weren't wholly responsible for inflation, they played a pretty significant role. So even though the Federal Reserve was able to get inflation back down to 3% in 1972, a lot of the reason why there was inflation in the early 1970s and then again in the late 1970s and the early 1980s was because of things that were outside of the control of the American government. So here's the reality. Even though the Fed in 1972 was able to get inflation back down to 3%, it was the unexpected shocks, the unexpected surprises that saw inflation increase drastically. And going forward over the next 3 to 5 years, if all else remains equal, we're probably going to see inflation remain pretty flat. However, if there is a significant global issue like the pandemic, oil shocks, or even worse, a major global conflict, well, that's when we could see inflation rear its ugly head once again. Now, the good news is that the US is very much insulated, at least in part, from these massive oil shocks of the 1970s. Because oil production in the US has gone up significantly, with the US producing almost 13.4 million barrels of oil per day, which means they have a lot more energy independence. Although that being said, they also have a significant amount of dependence on other countries that they are potentially in conflict with right now when it comes to importing goods that are so vital to the American economy. So while from an inflation standpoint, it seems that things have pretty much leveled out, and we should be good for a while barring unforeseen circumstances, well, unfortunately, it seems to be the age of unforeseen circumstances. So when it comes to inflation and what is going to happen in the future, the reality is nobody can tell. What we need to hope for is that there aren't any major crises, but if there are crises, there are things we can do in order to prepare for them and be set up so that we can take advantage of them instead of getting destroyed by them. Because at the end of the day, the purchasing power problem is going to continue to be a purchasing power problem. The amount that our dollar is able to buy is going to continually go down. So in order to prepare for potential conflicts, potential crises, we need to make sure that we are investing, we're paying off debt, and that we're setting ourselves up so that the money that we save and invest is growing at least at the rate of inflation, if not faster. And as I've talked about on this channel before, the simplest way to prepare for any crisis is to eliminate as much debt as possible, own assets like real estate that retain their value relative to other investments over time, and once you've paid off your debt, take every other penny and invest it in a diversified portfolio. Something like the all-weather portfolio that allows you to take advantage when crises occur. Because the beauty of Ray Dalio's all-weather portfolio is that if stocks go up in value and bonds go down in value, you're able to take some of the profits from your stocks and buy bonds on the cheap. And if gold goes up in value and stocks come down in value, you're essentially hedging the losses in stocks with the gold. And of course, many of you know me for my feelings on the physical gold and silver industry. I do believe that buying gold and having it as part of your portfolio is a good bet, but not paying the premiums associated with holding it physically. And when you set up this portfolio, make sure that you make the effort to, on a consistent basis, put more money into it and rebalance it on a monthly or semi-annual basis so that you're constantly taking profits off of the things that are overvalued and putting them into the things that are undervalued. And the really good news about a portfolio like this is that when there is a major shock to the economy, it tends to lose a lot less value than if you had just simply put all of your money into something like stocks. And that is what will prepare you for the next big financial crisis. Oh, and by the way, if you want to see what always happens before a financial crisis so you can prepare for it, make sure you check out this video right here.